Joining us now, though, is the Chief Market Strategist of the Carson Group, Ryan Dietrich, to help us make sense of it all. And couldn't imagine a better guest. Ryan, good morning to you. Happy Friday. I know from your notes and your commentary throughout, you've been pretty steadfast in your confidence for the equity market. Don't want to say you've been proven right, but we'll just say there's a lot of green on the screen, new all-time highs. Talk to us big picture, how you assessing things.
Yeah, first off, thank you for having me back, Alex. I appreciate it. I love your discussion before I came on. So maybe I'll kind of build on some of those themes. You know, we had a 9.1% mild correction, or not even correction, mild pullback, right? And everybody freaked out. 2 weeks ago right now, literally everyone said, are we going to go into a bear market? Are we going to go into a bear market? You know, at Carson, we like to say it's not about good or bad, but it's about better or worse. Now, things aren't great. We can get into all the weeds of this, but things are a lot better than they were. And I'm kind of known for stats. I'll just give you one right now. The S&P 500 obviously we're up a lot today, so I'm assuming we're going to be higher. We're going to be up 3 weeks in a row, up at least 3%. All right, going back in history, that has only happened twice off the 82 lows and coming off of COVID. I get it. If you're a pure stats person, well, that's a small sample size. Yes, it is. But this blast of strength that we've seen is consistent with those 2 times. Stocks are up 30% a year later. Not saying we're going to be at 30% this time, but we are saying this blast of strength is not a short covering rally. I think making new highs today kind of confirms this. We were saying this for a couple weeks now, but we're still really optimistic that this is still going to be a pretty darn good year.
Ryan, I like your stats, and I like the one you point out here, the second fastest ever, going from oversold based off, I believe, a 14-day RSI to an overbought. And, hey, the stats are what they are. I'm sure you got some information on like what it looks like over a certain time when that happens. But I want to pick your brain as well on maybe why that makes sense, right? Like, I'm sure you had an idea of how 2026 was going to look. I'm not sure you had a war in the Middle East, shocking oil prices. If we're just looking at this from a portfolio manager perspective, like that changed the models. Quick adjustments were made, VAR shocks, etc. But then once there's time to assess it, and then you see the off ramp, it's almost like you just flip the cards over right again. It's back to the playbook. So I'm not surprised by this, but I want to hear what happens when this happens.
Great points there. Let's see, how do I want to tackle this? 2023, right about now, regional bank crisis. We all were worried. August of 24, we had the yen carry trade unwind. Everyone was worried, rightfully so. Of course, a year ago, near bear market with the tariff stuff. Now here we are at the war. And now layer on what you just mentioned there. So getting a little geeky, but I think we can do that here. An RSI is an overbought, oversold indicator. We were not surprisingly very oversold, right? It took 11 days to go from oversold to overbought. That is in the top like 20 all time in terms of overbought to oversold. Well, actually, no, I'm sorry, second most ever, second fastest ever. Only 82 was faster, but I looked at the top 10 times we were oversold to overbought. 6 months later, here's what matters to the listeners. 6 months later, the S&P 500 was higher, 9 of them, with some really, really good returns. Now, layering onto that real quickly, what do we see after all the panic was going on? Hedge funds selling the most they'd sold in a 6-week period since a 100-year pandemic or previous bear markets. Over-the-top bearishness, put-to-call ratio spiking. Literally everybody was hedged. I think that's why that market kind of went slow and steady. It took forever to even go down 9.1%, right? I mean, it took a long time. Everyone was expecting. If everybody's thinking alike, somebody isn't thinking. General Patton. And then we start to get just little bitty cracks of better news, and his beach ball was way under the water, and now it went up. But again, oversold to overbought in a hurry like we just did. It says 6 months from now, be expecting probably some pretty significant gains.
You know, I was talking with Kevin Davitt, I think, from NASDAQ the other week, and he was pointing out the drags that some of the big 5 stocks had on the first quarter for the NASDAQ. And it really got me thinking, like, we knew that happened because you look at the price performance, particularly a name like Microsoft. But I think if you would have told me those performances January 1, I would have thought that the headline index performance was a lot worse than that, given how concentrated things had been. So, again, to continue our conversation from the previous segment that I had with Kevin, the broadening that has happened in sort of all this noise has actually been really impressive and perhaps even healthy. So my question to you then, Ryan, I think you lay out the bull case quite nicely. The stats speak for themselves. What has you worried if something does? What are you looking for to say, hey, that's where my risks are, that's where I could be wrong?
Yeah, well, layering on kind of real quickly on the conversation with Kevin, I mean, listen, I'm with you. If you told me Microsoft is down over 30%, software doing what it did, I think the market would be down more. Oh, by the way, oil had like a Six Sigma event, which is only supposed to happen like every 1.2 billion years, but the market hung in there. Well, that surprised me too. But the things that we were looking at, even during the sell-off, that we were saying, listen, it's not as bad as they're telling us. Two things here I'll focus on, like you talked about with Kevin, actually. Relative strength, staples. Staples are that real kind of, boring area. If you see a bid, if you see strength out of staples, that's a warning sign. Well, listen, in March and April, staples underperformed. Okay. I mean, so that was telling us, it's not as bad as they're telling us because staples will probably get more of a bid. Then the other thing, we're not seeing that now. We're seeing staples underperform. Love it. That's great action. And then the credit markets. Look at credit spreads, AAA spreads, BBB spreads. What are high yield bonds, junk bonds, all that stuff. Yeah, there were some cracks recently with everything going on, but by no means were we seeing over-the-top worry. So those were clues to us that this wasn't going to turn into a bear market. So to wrap it up, put a bow on it, if staples start to outperform by a wide margin and credit spreads start to blow out a little bit, then we'd be more worried. But fortunately, we're not there right now.
Good stuff. We'll keep our eyes on all of the above. Ryan Dietrich, you enjoy your weekend, and we'll catch up soon. The chief market strategist for the Carson Group.